Hey everybody, Jake and Gino here, and today we are going to discuss how to make deals work in this current market cycle. G-Dad, the ceiling, it keeps raising and raising and raising. It's getting very challenging to buy on actuals. Bridge debt is being utilized more now than ever, and one of the main drivers is inflation. With inflation, you're having rising rental rates. Love me some alliterations. Sellers see this, they're not idiots, and they're pricing it into the future sales. So with that being said, we love to buy on actuals, but we're also realists, and it's not happening a whole lot in this market. You're seeing a lot of bridge debt, not a lot of stabilized stuff trading with agencies right now. So G-Dad, you got a beautiful shirt on today. Shed some light on the situation, my friend. Show us the way.
Jake, let's do a little exercise, me and you.
Push-ups, sit-ups, what do you want to do?
I'm going to ask you a couple of questions and you're going to answer.
Oh, man, you're going to make me think right now? All right. Let me get locked in here. You got
and this is for all the listeners. Did you think that the real estate market was at a high in 2018?
No, I thought it was in 2017.
Okay. Did you think it was a high in 2019?
And 18.
And did you think one was in 19?
20?
So my point is, we never know when the height of the market is.
Yeah.
But we do have a solution or a way to measure risk. We're always looking to limit our downside risk. How do we do it? We do it with what we call the 3 pillars of real estate. It's in creative cash. Hit me up, Gino at jakeandgino.com. I will send you a PDF copy of the book. Now, why do I mention the 3 pillars of real estate? Because the 3 pillars are, number 1, what Jake's talking about, the market cycle. Number 2, the debt component. And number 3, the exit strategy. You need to understand what part of the cycle you're in. We've been in a high cycle for the last few years. And Jake is talking about it. We're going from a high cycle to an even higher cycle, to an even more bubbly cycle. So the cycles keep shifting up. And so how are you planning on buying these assets? Back in 17 and 18 and 19, I would say we were still buying on some type of actuals. We were buying assets that were a little bit older because cap rates didn't compress with the C space yet. So there were still some buying opportunities in those older assets. And we were actually looking at those assets and buying them on actuals. Now, what Jake's talking about, you have to understand the 3 pillars of real estate. What you need to do first, everyone who's listening here, don't make the same mistake that Jake and I did when we first started buying. Understand what your exit strategy is on every single one of these deals. If you're buying with bridge debt now and you're looking to refi in 24 to 36 months, you may get caught with higher interest rates. So there's risk there. A lot, and I've been calling for this for the last 2 to 3 years because I thought rates were going to rise, but who knew that we were going to get COVID? We're going to go into that type of cycle where there's so much free money going into the market and rates were suppressed, and that brought out asset buyers and that brought out the lending from the banks. But what I'm saying going forward, when rates rise, don't know when, but it's going to happen sooner or later to combat inflation.
What do you mean? It's happening now.
I'm just saying, like, substantially to where, I'm underwriting at a 3.7% interest rate. I have to refi out at 5.5. That's going to really kill a lot of deals. So understand where you are in the market cycle. This may be the point where you say to yourself, I don't want to take on that additional risk where I'm underwriting deals and I'm buying a stabilized asset on bridge debt, hoping that I can continue to get this rent raises. That's really risky. So understand where you are in the market cycle. Understand what your exit strategy is. For Jake and myself, our exit strategy, especially in this part of the cycle, we want to get long-term fixed rate financing. We want to buy assets that may be a little bit newer or even older assets, but we have enough CapEx and enough budget where we can buy these assets, fix them up, make them brand new so we can hold them for the next 7 to 10 years without worrying about huge capital expenditures. We bought a 25 unit. Man, Johnny G was showing me the pictures today. You guys are magicians down there. The maintenance work that they're doing, turning these units, they have holes in them, all the wood rot. You're talking about water leaks, HVACs, roofs. Well, we have enough where we bought the asset right and we're investing into that asset. So for the next 10 years, the pride of ownership is there. We don't have to worry about replacing all of these things. And we know that we're buying it at a certain price point where rents are really suppressed, but we know right now we're testing, we know the measure where we can get those rents too. That's where we are in this part of the cycle. But everybody out there, this cycle is not going to last forever. So understand that your buy right criteria and how you're buying assets is always going to evolve. Your exit strategy may evolve. Back in 2013, when we were buying assets, a lot of syndicators out there were buying the asset, fixing it up, and flipping it, going to the next one. That was their exit strategy. Jake and I didn't have one. We were just buying these assets, and we were typically refining and rolling the vast majority. So that was the exit strategy for us. But understanding the clarity of where you are in the market, what kind of assets you want to buy now. We're buying smaller assets because that makes more sense in this part of the cycle. We're buying assets that are a little bit newer. We like assets that have washer dryer hookups, or we're going to put them in there. That's an amenity that people want. We're buying assets that are townhomes. We're buying assets that are a little bit newer. We love brick assets that have brick. We love a certain median income. Get clear on this part of the market cycle right now and be flexible. Understand your exit strategy and then couple the debt with it. That's what I think you're going to have to be able to buy in this current market cycle, in any market cycle. Understand that. Put those 3 pillars of real estate together. Learn about the 3 pillars in creative cash. And I think going forward, continually revising your strategy. And as a side note, every market is different. What's going on in Knoxville, Tennessee, in that part of the market cycle is different than what's going on in St. Augustine, Florida, and then what's going on in the Midwest, or in Cleveland, or in Buffalo, New York, or in Rochester. Understand what's going on in your specific market, and that will help you create your buy right criteria and will help you become successful in any market cycle.
I love the John Madden quote, take what the defense gives you. If we're in a room of 100 real estate multifamily investors right now, and I said by a show of hands, who's buying on the front end, putting initial conventional Fannie Freddie debt on your deals on the front end? And I would say probably 20, maybe 30% would raise their hands. Reverse engineer that. Think about that. Take what the defense is giving you and apply that to the market. So if that's a little bit too much in the clouds for you, I'll break it down a little bit more specifically and kind of discuss what we're doing, but let your brain work. Think about the current environment, the current situation, and how you can win. Okay. So number one, you got to be in a growth market right now, I think, to make things work. You got to have population growth and you have to have rental rates on the rise. Okay. You need to see it and you need to understand it. Okay. You need to understand your comps. What do I mean by that? What are things going for? If you see something that is a 1980s build, rents are 700 and they want 100,000 per door for it. Just saying. You need to be able to go in, for me at least, I want to know that if I'm paying 100 for it, I'm going to be able to get the rents after renovation to 1,200. And I need to know my comps. I need to know them very well to be able to achieve that. So you are rolling the dice. Okay. You could get caught potentially. That's why, Gino, talk about our 25 unit, much less risk there in this part of the cycle, doing a 25 versus a 200. If you're going in with that strategy, less chance to get caught. Diversification, doing a small percentage of your portfolio like that right now. That's what we're doing. Quality construction. I was joking with Gino the other day, and we call this climbing the ladder. But we're really looking at the quality of the boxes, okay? Gino mentioned before, we like townhomes. We want washer dryer hookups. We want 1980s or newer. We love brick. What kind of condition the roofs, parking lot in, plumbing, yada, yada, yada. Okay, because we're going in and we're basically flipping boxes this point to ourselves in a refi. What's the mindset? Long-termism. We say this all the time. If you're going to do a strategy like ours right now, you need to have a long-term mindset. Years ago, we'd buy in actuals. Cash flow from day one. Love it. Well, you got to wake up. It's not 2013 anymore, Gino, right? So now you need to be a little more patient. So if the rents are going to be 700, you're paying 1,000 per door, and you think you can get them to 1,200, that's a good deal for us. We like it. It works well. We're added to the snowball. We're making money with it. So
100,000 per unit. And yeah, what I would like to say, yeah, you said 1,000 per unit. 100,000.
That's even better. You're going to make real good money on that.
Those days are long gone, my friend.
Yeah, but 700, 700 in rents, maybe paying 100,000 for it when you're hoping to get them to. Yeah, I like 1,200. I like to beat the 1% rule, right? We don't want to be stagnant with it. So,
but like Jake is saying, that is our personal buy rate criteria. That's where we are. Jake is talking about the 20% of the people buying Fannie and Freddie. They're underwriting deals differently than the average investor. They've got capital.
Big time loan to value. Okay. You're talking 40% down and some of these.
They have a cost of capital, which is very low, and they need to place the capital. That may not be where Jake and Gino is, or you, the listener, are right now. So be aware of that. Have an open mind. Be logical. Be rational. Don't be emotional about these assets. Once you put emotions
into the value. Yep.
And one last thing I would like to say about value. Maybe in this part of the market cycle, we like to say valuation with operation, not just renovation. You're looking to renovate deals. And so this part of the cycle, you may buy an asset where you can get rents from 700 to 1,000 without even renovating the unit. You may be able to do that. It's all about the operations in this part of the market cycle as well. So write that down, everybody. Valuation through operation, not renovation.
Where'd you get the shirt?
Untuck It.
Dude, it's really nice. Where can we get the book?
Gino at jakeandgino.com. Listen, we're going to have a debt crisis, not in the form that everyone's going to think. The problem is that a lot of these banks don't want to take risks. So that loan to value is dropping.
That's the truth, dude. They want They want absolutely zero risk. Give it to me on a silver platter and take all the risk off the table. 40% loan to value. Let's go.
And a lot of these deals do not qualify for a lot of the debt. So a lot of these sellers want to sell. So creative financing, that's why I keep showing this book, a lot of creative financing techniques, whether it's with the master lease option or it's owner financing, you'll find it in the book. And more importantly, you'll find the 3 pillars of real estate in there as well.
I bet most of these conventional deals that are selling right now, meaning they're going to agency first, Fannie Freddie, 65% LTV, 60% would not surprise me.
60 to 65%. I would say the vast majority of them. I agree with you.
Right on, right on. Looking good, my brother. We'll see you next time.
Thanks, Jake.